Hello, this is Charlie, your professor instructor for accounting for emergency responder administrators. I wanted to record a video lecture for the material in Chapter 3 to kind of provide a little context and overview of the material, maybe help you understand what's going on there a little bit better. I want to start from the premise that accounting information is important and useful, okay, for making decisions, especially ones that are based on investment or to make an investment. There's some very important concepts presented in the chapter, primarily how to compute and interpret financial information. And again, one thing to keep in mind, the ratios that are presented here are not exhaustive. All right, the analysis is kind of the more common general type of measures, return on investment, liquidity measures, and even for these common set, there's profitability, liquidity, and what are called activity ratios. For each industry, there are unique performance measures that are used to gauge the financial performance or the overall performance of a business or entity. And then we get into governmental entities, which, like I said earlier, most of you will be a member of as an administrator. They have unique measures too that we'll see later in the semester. So anyway, for all the analysis, keep in mind a couple important limitations or caveats. You need multiple data points. Computing a ratio or financial performance measure for a particular company at a point in time has really limited value, simply because all it tells you is one measure. It's hard to say whether that business is on a downward trend or upward trend, how it compares to its competitors. For example, a low performing profitability measure may be the star of the industry, of its peers, so you have to look at it in the context of expectations, some benchmark. And so typically we'll look at trends over time, what's the last 3 or 4 years look like, or 5 years, or what's the current industry trend, and where do we fall, where does the company or entity that we're looking at, interested in, where do they fall in that? Are they number one, are they number two, are they the bottom of the pack? Okay, so a couple of the important measures that are introduced here are return on investment. And again, this is a real important measure, and it focuses on the total amount invested in a particular opportunity or project. So sometimes you might be thinking about a whole business. Sometimes it's to develop a new product or to acquire a business, something of that nature. And so you're looking at, okay, so what was the required investment? How much resources did I put into it? And what have I earned from that? Okay, so that's ROI. ROE is a slightly different measure, and it's from the equity or stockholders' perspective. And the reason why it's different from ROI is the fact that companies borrow money. Okay, and so this is called leverage or gearing. And what it does is, if a company has an investment opportunity that's going to, say, pay 10%, and they can borrow money, they can take out fixed loans for 5%. The shareholders are better off if they at least finance part of that new investment by borrowing, because the difference between the 5% on the debt and the return on the project of 10 goes to equity holders. And so the return on equity can be equal to the return on investment or much higher. And that's the case in the example that's used throughout the chapter of Campbell Soup Company. Okay, a couple other measures there, working capital. So okay, the first two there, ROI and ROE, are profitability measures. And there's some important main categories of financial statement analysis. One is, okay, profitability measures like ROI, ROE, liquidity measures like working capital, current ratio, quick ratio, or asset test, and then activity ratios, which we'll touch on later. Okay, all those are real common measures that are commonly used for many firms across many types of industries. There's also trend analysis. So we would look at a particular number, like, say, total sales or gross profit percentage, or any measure, cash even from the balance sheet, over time. What is that trend? And many trends can be explained by environmental factors, the growth of the business or decline of the business, general economy. What's the general economy like? Is it driving increase in overall business, or is it contracting? Okay, so working capital. The current ratio is just a measure of current assets, so things that are available, resources that are available to pay bills right now and in the next year, against those that are going to be due. So current outstanding obligations, and those are basically the things that are due right now that have to be paid within the next 12 months. The other ratio that's an adaptation of that is called this acid, or commonly called quick ratio. And the difference between the current and quick ratio or acid ratio is you're going to throw out things that aren't as liquid or aren't as sellable. So you're going to look at just cash and accounts receivable, because you can actually take receivables and sell them to an investor like a bank or another third party and turn it into cash with a small discount. Inventory, prepaids, those are not so sellable, and so we throw those out in order to compute the acid or quick ratio. And this is a measure, just as it's pointed out, if you had to pay bills today, what's your ability to do that? And if it's less than 1, it says, hey, we really need to be able to sell this inventory. And so you look maybe then at how often inventory turns over. Do we have inventory that's hard to sell? Is it we've got like several years worth sitting in the warehouse right now? That would be a concern to many investors or managers. Okay, and then the trend analysis, as I spoke to earlier, just allows you to look at what's going on over time. And this is really important. And you want to look at, again, in the context of some expectation or benchmark, which is typically the industry average. And industry data is available from lots of sources. The authors use Campbell Soup's financial statements for many of the examples, and that's at the end of our textbook. So I encourage you to walk through those illustrations, those examples, see where the numbers come from, make sure you understand how they're computed, because we're going to do many of these on our assignments and also on the exams. All right, so if you have questions or need clarifications, send them to me. I'm happy to answer them and provide that. Over.